72 hours ago. Something fractured in the silver market that most Americans will never hear about on the evening news. Deutsche Bank now owes delivery on 3 million ounces of physical silver. That's 10% of the entire registered inventory backing every futures contract in New York. Meanwhile, JPMorgan quietly acquired 80% of available deliveries. And across America, the most trusted silver coin just vanished from retail shelves completely. 3 pressure points, 1 market, and a leverage ratio that would make 2008 look like a practice run. What happens when the music stops and everyone realizes there aren't enough chairs? Welcome to Currency Analyzer, the channel where we don't sugarcoat financial reality. If you've spent decades watching markets, building businesses, or simply understand that economic storms don't announce themselves on cable television, then you're in the right place. Take a moment now. That small subscribe button below this video. It costs nothing, but it ensures you won't miss the analysis that matters when the next shoe drops. And before we dive into why 3 simultaneous cracks in the silver market signal something far larger, drop a comment. Tell us where you're watching from. New York, London, Singapore, Mumbai. Because what's unfolding right now doesn't respect borders. Let's begin. On the trading floors of Lower Manhattan, a clock is ticking. Deutsche Bank sits at a desk it never intended to occupy, holding contracts that demand something the modern financial system was designed to avoid. Physical delivery, 3 million ounces of silver, not as numbers on a screen, not as cash equivalent settlement, but as actual metal that must move from warehouse to vault, from their possession to someone else's. This is not how the system typically operates. For decades, futures markets have functioned on a quiet understanding, an unspoken agreement between all participants. Traders buy contracts, they sell contracts, prices move up and down, and when expiration arrives, nearly everyone rolls forward or accepts cash settlement. Physical delivery represents the exception, not the rule. But January 2025 brought a change. Contract holders began demanding what the contracts technically promise, the metal itself. And Deutsche Bank now faces an obligation that represents 10.6% of the entire registered inventory at COMEX, the commodity exchange in New York that backstops the largest silver trading platform in the Western world. To understand why this matters, one must first understand what registered inventory actually means. COMEX warehouses hold 2 categories of silver, eligible and registered. Eligible silver sits in approved warehouses, but it belongs to private owners who have simply chosen secure storage. This metal cannot be used to settle futures contracts unless the owner explicitly transfers it to registered status. Registered silver, however, stands ready for delivery. When a futures contract demands physical settlement, this is the only metal that counts. As of early January 2025, COMEX reported approximately 28.4 million ounces in registered status. Deutsche Bank must deliver 3 million ounces from this pool. The mathematics become uncomfortable quickly. If one entity's delivery obligation consumes more than 10% of available supply, questions emerge about whether the remaining inventory can satisfy other contract holders should they also demand delivery. This is not theoretical concern. History provides clear precedent for what happens when delivery demands exceed comfortable inventory levels. In March 2020, as pandemic uncertainty gripped global markets, COMEX registered silver inventory dropped to 55 million ounces, while open interest surged. Premiums spiked, delivery delays appeared, and the exchange was forced to approve new warehouse facilities to prevent a settlement crisis. In 2011, during silver's climb toward $40 per ounce, registered inventory fell below 30 million ounces, while open interest exceeded 140,000 contracts. The exchange responded by raising margin requirements 5 times in 8 days, effectively breaking the rally by making it prohibitively expensive to hold positions. And in 1980, when the Hunt brothers attempted to corner the silver market, their accumulation strategy centered on demanding physical delivery until registered inventories could no longer satisfy contract obligations. The exchange changed the rules mid-game, implementing Silver Rule 7 that restricted new long positions, forcing liquidation, and ending the corner attempt. Each historical episode shares a common thread. When physical delivery pressure exceeds the system's capacity to deliver, either prices spike dramatically to discourage further delivery demands, or the regulatory authorities intervene to protect the exchange's settlement integrity. Deutsche Bank's current position sits at this intersection. The bank faces contractual obligations under regulated exchange rules, but the available inventory to satisfy those obligations represents a shrinking pool that must also service every other contract holder on the platform. Warehouse logistics add another layer of complexity. Silver bars must meet specific weight and purity standards. They must physically move from one warehouse location to another. Transport requires security, insurance, and verification procedures that cannot be compressed beyond certain timeframes. Contract expiration dates do not extend indefinitely. If Deutsche Bank cannot source the required metal from registered inventory, it must either convince eligible inventory holders to convert their metal to registered status, or it must default on delivery, triggering cash settlement at whatever premium the market demands. Neither option appears comfortable. Converting eligible to registered requires negotiations with metal owners who may prefer their current storage arrangements. Default triggers, reputation damage for a major financial institution already navigating post-2008 credibility challenges. And all of this unfolds while JPMorgan, Deutsche's competitor and counterparty in numerous markets, controls the majority of recent physical deliveries. The question facing market observers is not whether Deutsche Bank will settle its obligations. The question is what that settlement will cost, and what it reveals about the true relationship between paper contracts and physical metal, a relationship that may be far more fragile than most participants realize. In the world of high finance, silence often speaks louder than headlines. While financial media obsesses over quarterly earnings and interest rate predictions, a different story has been unfolding in the shadows of commodity warehouses across North America. JPMorgan Chase, one of the largest financial institutions on the planet, has been quietly doing something that defies conventional banking logic. They have been taking physical delivery of silver, not occasionally, not as a hedge against portfolio risk, but systematically, methodically, and in quantities that now represent approximately 80% of all silver moving out of COMEX registered warehouses in recent months. This is not normal behavior for a modern bank. Banks trade derivatives. They manage risk through offsetting positions. They collect fees from facilitating transactions between other parties. What they typically do not do is accumulate massive stockpiles of physical commodities that require storage, security, and insurance. Yet JPMorgan has been doing exactly this. To understand why this matters, one must look beyond the simple act of taking delivery and examine the strategic positioning it creates. Every ounce of silver that JPMorgan removes from registered inventory serves two simultaneous functions. First, it reduces the available pool that other contract holders can claim for delivery. Second, it places that metal under JPMorgan's direct control, removed from the exchange's immediate reach, stored in private facilities rather than COMEX-approved warehouses. The bank is not simply buying silver. It is removing it from the very system it operates within. Data from warehouse receipts tells a remarkable story. Between 2011 and 2020, JPMorgan accumulated an estimated 133 million ounces of physical silver through steady deliveries that rarely attracted public attention. Industry analysts who track warehouse movements noticed the pattern, but mainstream financial coverage largely ignored it. The accumulation continued even after a significant legal event in 2020. That year, the U.S. Department of Justice charged JPMorgan's precious metals trading desk with spoofing, a form of market manipulation where traders place orders they intend to cancel, creating false signals about supply and demand to move prices in their favor. JPMorgan paid nearly $1 billion to settle those charges. The settlement included admissions that traders had engaged in thousands of manipulative episodes over nearly a decade, using sophisticated algorithms to place and cancel orders faster than human traders could detect. What happened after that settlement reveals something important about institutional behavior. The spoofing stopped, at least in its electronic form. But the physical accumulation accelerated. If one cannot manipulate paper prices downward to facilitate cheaper purchases, another strategy emerges: accumulate the physical metal itself, and wait for the paper market to discover its vulnerability. This is not speculation. It is pattern recognition based on documented behavior. Markets operate on leverage, on the assumption that not everyone will demand physical settlement simultaneously. COMEX currently holds open interest representing roughly 356 million ounces of silver, backed by only 28 to 32 million ounces in registered form. That represents a leverage ratio of approximately 12 to 1. 12 paper claims for every physical ounce available for delivery. This structure works smoothly when participants accept cash settlement or roll contracts forward. It breaks down when someone begins systematically removing physical metal from the registered pool. JPMorgan understands leverage better than most institutions. The bank survived 2008 by acquiring Bear Stearns and Washington Mutual at bargain prices, while competitors collapsed. It has navigated multiple regulatory crises, paid billions in settlements, and emerged each time with its market position strengthened. Its silver accumulation strategy follows similar logic. By controlling 80% of physical deliveries, JPMorgan creates optionality, the ability to respond to market conditions in ways that competitors cannot. If paper prices spike due to delivery pressure, JPMorgan holds physical metal that appreciates in value. If registered inventory drops to critical levels triggering supply concerns, JPMorgan controls metal that becomes increasingly scarce. If other institutions face delivery obligations they cannot satisfy, JPMorgan holds metal it could potentially lease. That term's favorable to JPMorgan. This is not a conspiracy. It is strategy. The same strategy that Glencore uses in aluminum, that OPEC uses in oil, that any sophisticated player uses when they recognize structural vulnerabilities in commodity markets, control the physical, and paper prices eventually converge to physical reality. The timing of JPMorgan's recent accumulation adds another dimension. As Deutsche Bank faces its 3 million ounce delivery obligation, as retail American silver eagles vanish from dealer inventories, as Chinese export restrictions remove 112 million ounces annually from global supply chains. JPMorgan continues removing metal from registered status. The bank is not causing these pressures, but it is positioning itself to benefit from their resolution. This represents classic crisis capitalism, the recognition that market dislocations create opportunities for those with resources and patience. JPMorgan has both. The question observers should ask is not whether this accumulation is legal. It appears to operate within exchange rules. The question is, what happens when the institution that controls the majority of physical deliveries also operates trading desks that profit from price volatility? And whether the remaining registered inventory can satisfy delivery demands from everyone else, while JPMorgan watches from a position of strength it has spent years constructing. There exists a coin in America that transcends mere currency. For nearly 4 decades, since its introduction in 1986, the American Silver Eagle has served as the most recognized, most trusted, most widely held silver coin in the Western world. Walk into any coin shop from Seattle to Miami, and dealers will tell you the same story. When customers think silver, they think eagle. 1 troy ounce, 99.9% pure, backed by the full faith of the United States government, featuring walking liberty on the obverse and a heraldic eagle on the reverse. It represents something psychological as much as financial, a tangible connection to value that exists outside the banking system, outside the digital ledgers, outside the promises of institutions. In January 2025, that coin disappeared. Not gradually, not through normal supply fluctuations, but completely. Major bullion dealers across the country began updating their websites with a message they had not posted since the financial crisis of 2008. Out of stock. Phone calls to customer service lines produced the same response. We have no American Silver Eagles available, and we cannot provide a timeline for when inventory will return. This is not a story about delayed shipments or temporary production slowdowns. This is a story about systemic supply breakdown at the retail level, the point where ordinary Americans convert dollars into physical metal. The numbers reveal the severity. In 2024, the U.S. Mint sold 42.6 million American Silver Eagles, the highest annual sales figure since 2015. Strong demand, certainly, but demand that the production and distribution system managed to satisfy throughout the year. Premiums remained reasonable, typically $3 to $5 over the spot price quoted on financial networks. Then the calendar turned to 2025. Within the first 2 weeks of January, premiums on whatever scattered inventory remained spiked to $12 to $15 over spot. Let that sink in for a moment. If COMEX futures show silver trading at $75 per ounce, the actual price an American citizen must pay to acquire a single Silver Eagle now reaches $87 to $90, a 50 to 60% markup over the official price. This divergence tells a story that transcends supply and demand economics. It reveals 2 completely separate markets operating on 2 completely different realities. One market trades contracts, digital entries, promises backed by shrinking physical inventory. Sophisticated institutions transact millions of ounces daily through keystrokes, never touching metal, never moving bars from vault to vault. The other market deals in actual coins and bars that people hold, store, and own outright. This market operates at coin shows, through dealer networks, and private transactions, where trust matters more than regulatory oversight. When these 2 markets price the same commodity at a 60% difference, something fundamental is broken. The U.S. Mint operates under specific constraints that explain part of the breakdown. The Mint does not sell directly to the public. Instead, it sells to a network of authorized purchasers, roughly a dozen wholesale buyers who must meet minimum order requirements of 25,000 ounces. These authorized purchasers then distribute to retail dealers who sell to individual customers. This 3-tier system usually functions smoothly, but it contains vulnerability points. The Mint's production capacity, while substantial, cannot instantly scale to meet demand surges. Dies wear out, blank planchets must be sourced, quality control cannot be rushed. If authorized purchasers cannot obtain sufficient inventory from the Mint, retail dealers run dry. And if retail dealers have no inventory, premiums spike as customers compete for whatever remains available. But production capacity alone does not explain the current situation. The upstream supply chain faces pressures that compound the retail shortage. Blank planchets, The silver discs that become coins after striking depend on refining capacity. Refineries take raw silver from mining operations or recycled sources, process it to 99.9% purity, and produce the blanks that mints require. On January 1st, China implemented export restrictions that eliminated 90% of the silver exporters who had been feeding Western markets for years, 112 million ounces annually, simply removed from global supply chains. That represents roughly 3 months of total American silver eagle production, vanishing overnight. Refineries cannot instantly replace that lost supply. Mining operations cannot accelerate production on short notice. The entire supply chain from ore to coin operates on timelines measured in months, not days. Meanwhile, retail demand accelerated precisely when supply contracted. Americans watching financial news coverage of banking stress, reading about Deutsche Bank's delivery struggles, hearing whispers about shortage concerns, responded predictably. They tried to buy silver eagles and discovered that none were available. This created a psychological feedback loop that intensified the pressure. Scarcity drives urgency. Urgency drives competition. Competition drives premiums higher. Higher premiums signal greater scarcity, and the cycle reinforces itself. Behavioral economics calls this reflexivity, where market participants' perceptions actually create the reality they feared. But here is the deeper implication that most Americans miss. The silver eagle serves a specific function in the precious metals ecosystem. It represents the bridge between institutional markets and individual ownership. It converts abstract commodity prices into tangible assets that ordinary people understand and trust. When that bridge breaks, when the flagship product of the United States Mint becomes unavailable, it sends a signal that transcends silver markets. It suggests that the conversion from paper to physical, from digital promises to tangible assets, may be approaching limits that the system cannot accommodate. Coin dealers now quote 6 to 8 week delivery times for pre-orders, if they accept orders at all. Some have stopped taking new customers entirely, focusing only on existing relationships. Secondary market prices for silver eagles purchased years ago now command premiums that make their original buyers look prescient. And across kitchen tables in American homes, people hold coins they bought for $25 or $30, watching them trade for $90, while wondering what happens if the gap between paper and physical continues widening until it cannot be ignored any longer. There are moments in financial history when separate threads weave together into patterns that reveal structural truths most participants prefer to ignore. January 2025 represents one of those moments. 3 pressure points, each significant on its own, have converged simultaneously in the silver market with timing that forces observers to confront uncomfortable questions about how modern commodity trading actually functions. Deutsche Bank struggling to deliver 3 million ounces against thinning registered inventory. JPMorgan controlling 80% of physical deliveries while that inventory shrinks. American silver eagles vanishing from retail channels as premiums explode to 60% above spot prices. Individually, each situation could be explained away as temporary disruption, normal market stress, or isolated supply chain friction. Together, they form something more troubling. They expose the fragility of a market structure built on leverage, paper promises, and the assumption that physical demand will never exceed a carefully managed threshold. That assumption is now being tested. To understand what makes this convergence historically significant, one must examine the mathematics underlying futures markets. COMEX currently reports open interest representing approximately 356 million ounces of silver. This is the total amount of silver that all outstanding futures contracts theoretically claim to represent. Every contract promises potential delivery of physical metal if the holder demands it. Against this 356 million ounces of paper claims, the exchange holds roughly 28 to 32 million ounces in registered status, the only inventory actually available for delivery. The ratio is approximately 12 to 1, 12 paper claims for every physical ounce. This is fractional reserve commodity trading, and it operates on the same principle that allows banks to lend out more money than they hold in deposits. It works smoothly when only a small percentage of participants demand physical settlement. It breaks when too many try to convert paper to metal simultaneously. Think of it as a bank run. But for silver, if every depositor showed up demanding their money at once, the bank could not possibly satisfy them all. Banks operate on the understanding that withdrawals will remain within predictable ranges, allowing them to lend most deposits while keeping only a fraction in reserve. Futures markets function identically. The exchange assumes that most traders will roll contracts forward or accept cash settlement, allowing registered inventory to remain far below open interest. But what happens when that assumption fails? History provides 3 clear precedents worth examining. In 1968, the London gold pool collapsed when central banks could no longer supply enough physical gold to suppress prices through coordinated selling. They were defending a fixed gold price while demand exceeded their willingness to deliver metal. When France demanded physical delivery of its gold held at the Federal Reserve, the system broke, the gold pool dissolved, and the price subsequently multiplied several times over. In 1980, the Hunt brothers attempted to corner the silver market by systematically demanding physical delivery until registered inventories could no longer satisfy contract obligations. At the peak, silver reached $50 per ounce. Adjusted for inflation, that equals roughly $170 today. The exchange responded by changing the rules, implementing restrictions that forced liquidation and ended the corner. In 2011, silver climbed from $30 to $49 in a matter of weeks, as physical demand surged following the financial crisis aftermath. COMEX registered inventory dropped below 30 million ounces, while open interest exceeded acceptable leverage ratios. The exchange raised margin requirements 5 times in 8 days, making it prohibitively expensive to maintain positions, breaking the rally almost overnight. Each episode ended the same way. When physical delivery pressure exceeded system capacity, authorities intervened to protect the exchange's settlement integrity, not to protect contract holders demanding delivery. The current situation contains elements of all 3 historical precedents. Like 1968, it involves questions about whether paper claims can be satisfied with available physical supply. Like 1980, it involves concentrated accumulation by a major institution while another faces delivery stress. Like 2011, it involves retail demand surging precisely when wholesale inventory reaches concerning levels. But there exists a critical difference this time. In previous episodes, the pressure came primarily from one direction: speculators driving prices up, or industrial users scrambling for supply, or investors fleeing currency debasement. This time, pressure arrives from 3 simultaneous directions: institutional delivery obligations that must be satisfied, strategic accumulation, removing metal from available supply, retail demand that cannot be met through normal distribution channels. The convergence creates a situation where each pressure point amplifies the others. Deutsche Bank's delivery need competes with JPMorgan's accumulation for the same shrinking registered inventory, while retail shortages signal that the entire supply chain from refinery to consumer faces stress. This is not orchestrated conspiracy. It is emergent complexity arising from structural vulnerability. Market participants acting in their own rational self-interest, unaware or unconcerned that their collective behavior approaches systemic limits. The question facing anyone watching these developments is not whether the silver market will resolve this tension. Markets always resolve tension, eventually. The question is how that resolution occurs, and what it costs those caught on the wrong side when it happens. There are essentially 3 pathways forward. First, prices could spike dramatically to discourage physical delivery demands, drawing out scrap supply and recycling, rationing available metal through price rather than availability. Second, regulatory authorities could intervene, changing exchange rules to favor cash settlement, protecting the exchange at the expense of contract holders who expected metal. Third, new supply could materialize from unexpected sources, eligible inventory converting to registered, imports accelerating despite Chinese restrictions, mining operations increasing output. Each pathway has historical precedent. Each involves winners and losers, and each reveals something fundamental about modern commodity markets that extends far beyond silver. These markets operate on trust, on the belief that paper claims represent real assets, that contracts will be honored, that delivery mechanisms function as advertised. When 3 simultaneous pressure points test that trust, when premiums diverge 60% between paper and physical, when major institutions scramble for delivery against shrinking inventory, the market is sending a signal that careful observers should not ignore. It is revealing the gap between what financial systems promise and what they can actually deliver when everyone tries to cross that bridge from paper to physical at the same time. The silver market may be small compared to bonds or equities, but the principles it reveals about fractional reserve structures, leverage ratios, and delivery mechanisms apply to every market built on similar foundations. And those foundations are now being stress tested in real time.